Hi guys, welcome back to another episode. This week has been a big week in the stock market. At the start of the week, global markets were hit hard on the back of tariff news. This was in response to Trump's tweet that there will be an additional 10% tariff on $300 billion worth of goods and services. Subsequently on Wednesday, the Reserve Bank of New Zealand cut rates by 0.5% to 1%, which saw New Zealand markets rebound from the earlier news this week about the tariffs. So this portfolio was started before all these events happened on the 1st of August 2019. So let's see how it's performed. The portfolio has returned around a loss of 0.5%. The calculation includes the 0.5% transaction fees when you buy individual stocks on Sharesies, and the rest of it is made up of movements within the portfolio. So during the week, I contributed $35 and another $10 were received from people who used my affiliate link. Thank you for supporting the channel. That brings total contributions for the week of $45. Of the $45, I added positions to EMF. So you can see here, I added positions to EMF, Emerging Markets Fund. I added positions to MYZ and Z Energy as well, NZX and Somerset. So I added that $45 went into these stocks. The worst performer during the week was EMF, and this was expected given EMF, the Emerging Markets Fund, mainly comprises of Chinese stocks, and Chinese stocks were hit the hardest on announcement of the trade war, and they haven't recovered as quickly as New Zealand stocks have. If you want live updates on the portfolio, make sure to follow me on Instagram at JWInvests, link in the description. Coming back to the rate cut, the RBNZ announced that they cut the official cash rate 0.5% to 1%, and that's a cut of 50 basis points, so it's been reduced to 1%. The reason why this was bigger news than other rate cuts was because the market expected a 0.25 quarter% cut or a 25 basis point cut. And because it was 50, this was unexpected. And because this was unexpected, it sent the New Zealand market back to levels where it started during the start of August. In this video, I'll be discussing interest rates and how it will affect the stock market and what this means to you as an investor in the stock market. This video is purely for entertainment purposes, and the opinions expressed in this video are my own and not necessarily the same of my employers. I am not an authorized financial advisor, and you should always do your own research before investing. Now, back to interest rates. The general rule is when interest rates go up, stock prices tend to go down. And when interest rates go down, then stock prices tend to go up. Here's a few reasons why. The attractiveness of saving goes down. When the cash rate decreases, the savings rate and the term deposit rates will most likely follow. A few years ago, I was getting 3 to 4% on my savings account. At the moment, it'll be hard to find any bank that offer more than 3% on a savings account, if not impossible. This makes shares as an alternative more attractive. For example, a Heartland Bank savings account currently offers a 2.15% savings account rate, whereas Heartland Bank stock pays about 7.8% in dividends. On the face of it, owning the bank seems more attractive than lending to the bank. When the savings rate drops, this makes owning shares even more attractive. So when people take out their deposits and buy more stock, this pushes the share prices upwards. Do note that stocks inherently have more risk than holding cash, so when you're buying stock, you're taking on more risk. The second reason why decreasing interest rates result in higher stock prices is because of an increase in consumer spending. When people see the interest rate on their savings account drop from close to zero to even closer to zero, there's less incentive to save and more incentive to spend. When consumer spending goes up, this leads to increase in business confidence. Companies make more sales, which result to increase in profits. And when companies make more profit, the value of those companies increase, resulting in an increase in share price. The third reason why decreasing interest rates will impact the stock market is because it will reduce the cost of debt. When interest rates go down, companies that borrow money pay less interest. This means that companies have more money left over after paying interest and taxes to their shareholders. Companies with high debt benefit more from this. Essentially, a reduction in the cost of debt will reduce the weighted average cost of capital, or more commonly known as WACC. The WACC rate will decrease, which in turn increases the present value of all future cash flows, resulting in higher stock prices. So what does this mean for you as an investor? This means that interest rates matter when investing. When interest rates are high, the opportunity cost of investing in shares is even higher, which usually lead to lower stock valuations, and vice versa. In our case, stock valuations are high because currently interest rates are at all-time lows, which means you're paying a high valuation for stocks. But be careful if you're buying shares looking for dividend yields at the moment, because you know that you're paying a high price at the top of the cycle. Decreasing interest rates cannot continue forever, and in our case the OCR is already at 1%, which means that there's not much room left to cut before it reaches zero. I want to finish off this video by talking about what you can do in the current market situation. The first thing is to invest in good quality companies that pay a good dividend yield. For example, in my public portfolio, I am invested in Heartland Bank and Z Energy, which pays a very satisfactory dividend and have fair valuations at current prices. In my portfolio, I focus on dividend investing, and the average dividend yield on my portfolio is about 3%, which is higher than most savings accounts. If you're looking to invest for the first time, then check out my video on 5 things you need to know before you start investing. Secondly, you should invest in undervalued companies which have a high margin of safety. So again, in my public portfolio, I'm invested in Somerset, which I feel is an undervalued stock with a considerable margin of safety as a shareholder, buying at these prices. When valuations are high, remember to dollar cost average in and to hold some cash to take advantage of any dips in the market. If you enjoy content like this, please leave a like and a comment. It helps the YouTube algorithm. And be sure to subscribe if you're looking for more investing and finance content. Until then, take care.